It's time for the Your Personal Bank Show with Ferenc Toth, president and founder of Secure Estate Management. Take charge of your financial future with your personal bank. Now, here's Ferenc Toth.
Welcome to Your Personal Bank Show. And as those of you who have been listening know that we've talked a lot about protection, guarantees and those kinds of things. Today I'm going to talk about growth. And I'll tell you what, there's some exciting tools out there that allow, we're going to call it performance. Okay, so we got performance versus preservation. And a lot of what I've talked about, and particularly recently with coronavirus and all that, is, being cautiously optimistic, protecting some of your portfolio, and talking about the steady, Eddie consistency of what many of the personal bank tools we use, many of the insurance products we use can grow consistently, steady, ongoing, irregardless of the economy and the market and interest rates and all those kinds of things, pretty much, okay? But there's also, and I've probably overly focused on that, frankly, because of what's been going on. But you know what? We have a whole performance side. And that's probably closer to the wheelhouse to a lot of the people that are listening here. I was focusing more on the protection side because, I find, and I've shared this many times, been in the financial industry, this is my 23rd year, working with many, many clients, and I find overwhelmingly so many of them are far more at risk than they want to be or more or comfortable when you really talk to them. And so we do a lot in the protection side, grow your money steady, consistent, all that good stuff. But what about growth? You know what? We have some awesome growth tools. So I'm going to touch on that a little bit further. Performance tools. I'll use it that way. What about performance? Well, basically, we can use the same type of tools. It's a different contract, different type of product and everything else. But it's designed for performance, for growth. And, many people are familiar if you use the traditional, say, the market model of mutual funds, managed funds, all those stocks, all those kinds of things, the S&P and all these things where, the count goes up, the markets go up, you earn whatever the returns are minus whatever fees there are. Okay, it's pretty straightforward, really. Well, how does the performance tool with the personal bank idea? Because what do we want to accomplish? We want growth. We want some tax benefits, and we want a floor. Okay, those are kind of the things that we really look at. And what I like is with the performance product, they've really juiced the performance, the growth. And I'm going to throw information out here, and I'm going to encourage you to contact us at yourpersonalbank.com. But you can get up to 2.7-fold increase on an index minus the fee. Now, what do I mean by that? First of all, it's a rider we use on an insurance contract that's designed to maximize cash growth, okay? But they have a rider that's a performance plus. It's a performance rider is what it is. And what they do, there's a rider fee. What they do with that is for those of you that are sophisticated in investing, understand that these companies purchase options to multiply returns. Options, I personally did options trading many years ago. I've never done it, for a client or anything. It was just something I did for myself, mostly because I'm wanting to understand, and had some success with it and some failures, like most anyone who you talk to in that arena. But there's some advantages. What's neat about it is some of the insurance companies, they have controls, some way to control it, we'll put it that way. So there's a curb, if you will, to the downside. There's a limit to the downside, which is really nice. And I didn't experience that personally, obviously. But the thing is, you can, like I said, you can invest the funds into like a typical S&P 500 index, for example. That's probably the most common. There's other indexes available. And what will happen is you'll get credited up to 2.7-fold increase of that index. Now, what do I mean by that? This hopefully is going to start getting some folks' attention. Because here's the thing. For example, if the index increased, let's use the S&P 500, increased 7%, and you got credited that 7%, 2.7 times that is almost 19%. Okay. just shy of that. So that would be your interest credit. There's a rider fee, currently at 7.5%. Now, again, that seems like a high fee. Well, if you're just looking at fees, yeah. But what are they doing with the money? Like I mentioned earlier, they're purchasing options to enhance, multiply the returns. So a 7% index credit would generate almost 19% credit. You take the 7.5% fee off of that, and you're about 11.5% return in your account. Why is that so significant? Remember, the index went up 7%. You got 11.5% credit, something like that. So it can enhance, turbocharge, or multiply, it's a factor, the returns. This is how we turbocharge returns. By the way, in simple terms, if you've had a 10% return, your credit would be 27 minus the 7.5, so you'd make 19.5% credit on a 10% increasing index. You can see how, depending on how much the index increases, your return is going to be a multiplication factor of that. And we can set up options with unlimited upsides. There's no cap to the upside. And again, the downside risk is the 7.5%. So what I tell people is when we're looking at this as an option, and I'm going to say this right off the bat, this isn't for everyone because you have to be prepared to accept a reduction of your account value in years where the accounts, where the market, the index, I should say, doesn't cooperate, doesn't go up that much or goes down. Oh, by the way, for one thing, if it goes down, they guarantee the downside. So you don't lose in terms of crediting. You still have the fee, don't get me wrong, so you can see a 7.5% reduction of your account value that particular year. Okay? So what I say to folks all the time is, look, if you want a factor, get something along the line, something above nearly 2 times what the index out there is doing with a downside limit of the 7.5%, that range, this could be of interest. Also, the other thing about the performance tool, it's used with an insurance contract, like I said, so it has some tax benefits. So now my example I was telling you about with a 7% index credit, your credit would be somewhere around 11.5%, and that's tax deferred. So you're not paying income tax on that money. And then you can use it with policy loans, access the funds, okay, in a tax-favored manner. So now we're starting to get interesting, again, with some downside protections. So like I said, I'm throwing something out here that is probably of great interest for a lot of folks. And for those of you that think that, this crisis is, we don't know, but if it's nearing an end and we're going to see some growth in our economy and the markets going forward, a recovery, if you will, you could definitely take advantage of that recovery and that growth using this performance tool. And you could get an enhanced factor over and above what the index credit or the index growth would be that in any given year, for example. The opportunity for upside potential is tremendous. And that's what's so exciting about it is, again, tremendous upside potential with a floor. And I said, I already mentioned, the floor is the 7.5%. So a negative 7. So you don't have to be as concerned about the dramatic drops in the markets because you've got that floor in place. If there's a negative, like I said, negative return in this account, it doesn't go down further. So, yeah, minus the fee. Oh, by the way, the thing about that rider fee is we can change that every year. We can reduce it. We can eliminate it. Obviously, the factors you get would be different. But if we feel like, markets aren't going to do that great, or the index isn't going to do that great this year, we can drop the rider fee. We're going to talk about that more in the next segment. Hopefully, I've got some of your attention, so stay tuned.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back to Your Personal Bank Show, and I'll tell you what, it's pretty funny. I started talking about growth, and I've already got some. I had some folks interested. With the personal bank tool, I've been talking about with the show so much about the protection side of things. And, of course, with the coronavirus, that's been of strong focus. But we do have a performance option, growth. It's focused on growth, and its goal is to enhance, in fact, a factor of 2.7 up to 2.7 times, so of whatever the index is. So if we're using the S&P 500, which is probably one of the most common, you can see it's 2.7 time fold return minus the fee. So I use the example of 7% index credit for the year. The S&P goes up 7% that year, and you get that credit. You can see almost just shy of that, almost 19% credit, and the fee is 7.5% currently. And so you would see about 11.5% on your account credited for that year. And remember, the index went up 7. So it went up 7, you got 11. It's not bad. When you calculate that out over several growth years, that extra factor, increase factor, that can be really tremendous. The downside, of course, is if the markets don't, here's a positive. If the markets don't cooperate, they stay flat or go down, you don't lose. And you saw the fee, the 7.5%, so you would have a reduction of the 7.5%. So that's kind of your downside floor, if you will. So as I tell people, again, this isn't for everybody, but for somebody who can handle a little bit more risk, but likes the idea of a floor and really likes the idea of that upside potential, this performance tool can be a great option. And here's the other thing, as I talk to clients about this, it's quite interesting. And it's funny when a lot of folks, they'll listen to the show and they're like, oh, I had no idea you did that too. Yes, because we do a lot of things. But when I talk to a person, really listening to them and determining what their situation is and what their needs are and what their goals are about their money. And it's funny, we'll talk about the protection option where, guaranteed, steady, Eddie, consistent. We've talked about current crediting of 5%, tax favored, consistent, steady, Eddie. We've talked a lot about that. And I've talked a lot about that because a lot of people I find have more at risk than they're comfortable being after really talking to them. But I also bring up the growth option here where you can have the 2.7 fold returns on an index minus the fee with the downside floor. And they're like, wow, and they start thinking, should I do one or the other? And then I'll usually bring up, well, there's no reason why we can't do some of both. And it's like an epiphany or a light bulb comes on. I'm like, oh my gosh, you're so right. Again, in the insurance industry, in our industry, there's a big pet peeve I have of mine I've talked about, and you've talked to, and I run into this more frequently than I care to admit, that we have agents out there, advisors, who focus on they love whole life and hate IUL, or they love IUL and hate whole life. And they're all one or all the other. And the thing I say to those advisors, those agents, is, it's not supposed to be about your personal bias. Again, when somebody says this product is always great or this product is always bad, they're just sharing their personal bias. It's supposed to be about the client and the client needs and the client goals and what they want. And it's not uncommon that I run into someone who's looking at a situation where they want some of their money to grow. They like the idea of the growth, the factor, the enhancement, the multiplier factor, if you will, with the downside floor. They can't lose more than a certain amount. And they like the idea of some of the money growing steady, consistent, regular, on a consistent, steady basis. There's nothing wrong with that. In fact, it's kind of preferable in many cases. So, again, we have a performance option. We have a growth option. And if you want more information on it, I'm just going to tell you, contact us at yourpersonalbank.com. Be happy to talk to you about your situation. You'll be reaching me. And, we can talk online, on the phone. We can meet in person if we want to. It's just your preference. Here's the thing. Let's look at your situation, and why not look at it where we can grow the money with an enhanced factor, okay, so that in, years that the indexes go up, the S&P, for example, goes up a certain percentage, you can get something over that, above that, okay? And the more it grows, we have unlimited upside option, for example. And then if we want some steady Eddie consistent monies, nothing wrong with that either. If we want to do some of both, there's nothing wrong with that. In fact, again, like I said, in many cases that can be preferable. So what I want you to understand is your personal bank is not like, it's not one specific financial tool. It's looking at your situation and looking at financial tools that enhance your cash growth, that minimize your taxes, that maximize access to funds. And like I was talking about last week, why not get away from all those rules, the IRA, 401k rules that are out there, the tax rules that seem to be consistently changing. You can get out of that world and take control of your money. Because if those rules don't fit your plans, then you got a problem, right? So again, you have access and use of your money. It can grow, all that good stuff. And like I said, we can take a portion of it. We can take whatever portion that makes sense for you to maximize growth. We can enhance a factor up to 2.7 minus the fee of what it can do. And, in a strong upward moving recovery market, so we go into a recovery and we have a strong bounce back, and you're taking advantage of more than double that. Think about that a minute. That return, that upside potential can be significant and can be pretty exciting, obviously. And it's also nice to know that there's a floor, that you can't go below a certain amount because they're guaranteeing the principal and you're just dealing with the fee. That's it. And like I said, we can look at changing that each year. So there's nothing requiring us to keep that in place. Now that'll change the factor each year. We can eliminate the rider fee, and we can just get whatever the index gets too. That's another option. See, again, my challenge and it's just trying to be a voice of reason, right? Is, which is better, upside potential growth or guarantees? Well, my point is, why not some of both? You don't have to have all one or all the other. But also, don't forget the tax situations. Why not have some tax benefits, right? With all of this. And that's what gets exciting about this. So we really do see people make tremendous growth in their accounts in good market years, good index crediting, and again, not worry so much. See, I've gotten really busy through this COVID crisis, it's created a financial crisis for many people. But what's kind of exciting is the busyness is not coming from our clients because they have downside guarantees. They understand that if they're in the fixed, consistent, steady Eddie, their account's going to go up no matter what. If they're in the growth performance side, they know there's a floor. It won't go worse than a certain amount. Okay? So they don't have to worry about the roller coaster and the volatility that we've seen recently. No, the people that are calling are the ones that saw me at a workshop, heard me on the radio or some other place and say, hey, you talked about this thing with some guarantees or downside protection. Is that still available? Those are the folks that are reaching out to me on a consistent, regular basis, which is great. I'm excited to talk to you and hey, welcome aboard. Love to talk to you about your situation and see how this could be a really good fit to really, truly maximize your upside potential growth. Put a floor on your downside so that it won't get any worse than a certain amount. Get some tax benefits and gain control of your money back again. That's really what the personal bank idea is all about. Stay tuned. We're going to talk about some more and a couple other ideas, opportunities that you can really take advantage of.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back to Your Personal Bank Show, and today we're talking about growth, performance, maximizing returns, having a floor on those returns, and I'm talking about a factor of up to 2.7 times fold of index returns. So, for example, an S&P 500 index. If your S&P 500 index credits, for example, 7%, you can get up to, it's almost 19%, 2.7 times that return for the year. There's a rider fee, 7.5%. So your credit would be about 11.5 that year. Did I get your attention? I hope so, because this is really an exciting tool that we often use in the performance side. We talk a lot about protection. We have the steady Eddie, consistent, guaranteed result. Don't get me wrong. For that person currently crediting 5%, and it's nice and steady, and you don't have to worry about the fluctuations and volatility and all those kinds of things because there's guarantees in place. But look, for the person who wants to turbocharge, juice their returns, get a larger return on their money, yet likes to have a floor, knowing you can't lose more than the rider fee, the 7.5%, which, by the way, is optional each year. It affects your factor on how much you're going to earn, of course. But my point is this: if you're going to go into an IUL type of situation where you're doing that to maximize returns, typically maximize cash growth, get some index credits, well, why not consider getting a factor of 2.7 times that with a floor, with some guarantees? Just makes a lot of sense. And I'm not necessarily saying you do this with all your money. I'm just saying for that portion of the money you want to apply to your growth bucket. I've talked a lot about the different buckets, the emergency bucket, the steady Eddie, consistent bucket of cash flow, and then the growth bucket. All right, let's talk about that growth bucket. Why not put in an account that's going to go up to get credit 2.7 times the S&P 500, for example, with a floor? And by the way, tax benefits also. That's where people get interested in these tools with the riders, and it really turbocharges, enhances growth. Again, I've shared this example already. A 10% credit could see a 27% index credit minus the 7.5%. So it'd be 19.5 basically would be credited that particular year in your account. Okay? Now, that's not going to happen every year. It's based on what the S&P 500 does. But in growth years that it goes up, recovery years, things like that, for your growth assets, this can be a tremendous tool. And I'm going to encourage you to contact us at yourpersonalbank.com to look at your situation specifically to see if this could be a good fit. Could we reallocate some funds that maybe you're wanting to reduce the volatility on? We all know, most market-related type of investments have unlimited upside and volatility to the downside. We can create that unlimited upside. We have options with the uncapped, unlimited upside, okay, with the 2.7 times factor. So the upside potential is tremendous, frankly. I've seen some really strong, I've seen some statements with some clients that are just pretty impressive, okay? Again, can't say it's going to happen all the time with everyone, but, there's some tremendous upside. Let's face it. Can't argue that point. And to have a floor, knowing it can't go below. So I tell people, look, how would you like to be in a position where you have unlimited, upside potential, 2.7 times fold the index return with a 7.5% floor, basically. So you won't lose more than that. And that can be optional, like I said, year to year. You need to contact us at yourpersonalbank.com for more information on this. Because if you want to take advantage of a market recovery and things like this, whenever that does happen, things are going to get better. That's America. Like I said, Warren Buffett says, I always bet on America. I agree with him. We don't know when exactly, short term, medium, long term, but things will get better. And you want to take advantage of that growth. Why not maximize that growth potential with a floor? That's why I steer people to this tool, this performance tool, when that's appropriate. And many times, a lot of the people listening to the show, that's their wheelhouse. That's kind of where you're at. And so don't think of this because, yes, we're using an insurance tool, but it's a maximizing cash value with an enhancement factor that just really juices the returns. It's worth looking at. That's all I'm saying. It's worth considering and taking a look at, because you can also get those tax benefits and whatnot in place also. So I really hope I'm getting some attention to some folks that maybe, They were all like, listen, I've gotten a lot of responses from a lot of folks, created a lot of buzz, and that's exciting. And I'm excited about that. Happy to reach out to people, talk to them. Like I said, contact us at yourpersonalbank.com. I'll respond to your inquiries, your questions, and whatnot. And we can meet on the phone, online, or in person, whatever is appropriate. But I've had a lot of folks looking at the steady Eddie consistent option that we've really been discussing a lot, again, because of COVID and things like that. And they're like, well, that's interesting. Certainly many have taken advantage of that because it makes sense to have some monies for them in that steady Eddie option. But others have said, I really want to move to the growth side more. I want to be more aggressive, whatever. And knowing I have a floor, knowing I can't lose more than that 7.5% in any given year, that's kind of a nice range I'm comfortable with, with significant upside potential with a floor. So if that fits you, and I'm going to venture to say that I would imagine with this audience, would it fit quite a few folks? Again, contact us, yourpersonalbank.com. We can go into it further. But that's really it. I mean, a lot of people try to make these financial tools complicated. And, that's sometimes one of the beefs or whatever they'll say on that kind of. They're not that complicated, really. I mean, there's some aspects to it, and there's some, how they work. But I always say to folks, look, have you ever read a mutual fund prospectus? I mean, they're pretty complicated to read. So the thing is, I find the contracts and how these things work to be quite a bit simpler. And if you just lay it out, boil it down to a few key things that are important, it just makes sense. And I guess I've had a gift, if you will, over the years of taking maybe what many people consider somewhat complicated or sophisticated financial tools and boiling them down to simple, understand key points and focus on what's really important. We look at the positive, we look at the limitations. I mean, it's not we're not being a, pie in the sky panacea kind of thing. That's why I say to people, this isn't for everybody. But what I say is, look, if you want that potential upside with the limit to the downside, and you're going to be somewhere in that range each given year, this can be a really good fit for you. And what I love about that is I don't have a lot of my clients reaching out to me with a lot of questions because they know what to expect. The thing I find is I don't like surprises, and especially when it comes to my money. I mean, if you know what to expect or you know what the range of expectations are going to be given year to year, it's pretty easy to understand. And that keeps things pretty smooth. It keeps my life simple, keeps everybody happy. And that's really what I strive to do is reach out to people, educate them, help them find a financial tool that maybe they haven't considered or looked at previously. And like I said, it doesn't, by the way, and when you contact me, it's not like we have to do everything in the growth performance side or everything in the fixed protection side. There's no reason why there can't be a mix of both. And together we can kind of determine what that mix, what makes sense. What amount to each side makes sense for you. Okay? And there's a lot of factors that go into that. Personality, age, your financial situation, all those kinds of things. But that's what we discuss. And my goal is to really listen to you. Here I'm talking on the radio, but actually I talk a lot less when we're in person because I'm wanting to find out about you and learn about your situation and what your goals and needs are with your money, and then try to find the best fit for that, the best tool, without having a preconceived notion or bias about is this bad, this good, or this is bad. Let's find the best tool, the best fit for you. That's what it's about. Contact us at yourpersonalbank.com. Love to talk to you. And like I said, we can either meet in person or online or over the phone.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back. Round and third, and we're going to finish up today. I've been talking about a topic that a little different because we've been focusing on other things and safety and guarantees. Today, we're talking about growth. Today, we're talking about performance. See, there's a performance option within the whole umbrella of the personal bank concept that most people overlook, or I haven't talked about, and that's my fault, as much as I should have. But here's the thing. We have a performance tool that can get you 2.7-fold return of the index, typically an S&P 500. We can use other indexes with a floor, which is the fee, never being less than 7.5%. So your downside is 7.5% for the year. Your upside is, well, we have unlimited options. And again, 2.7-fold or 2.7 increase minus the fee of what you would earn, what the index would earn for the year. A 7% index credit, for example, would amount to almost 19% credit minus the 7.5% fee. So your credit would be around 11.5. So remember, the index did seven, you got 11.5. I find when that happens, most of my clients are pretty happy. If the index credit is 10, you get 27, 2.7-fold minus the 7.5. You're ended up with 19.5. Remember, the index did 10. You got almost double that. Most folks are pretty happy with that. Market doesn't cooperate. The principal's guaranteed, and you only have the writer fee. You lose the 7.5%. So that's your worst. That's your floor. Okay, and we can. And that fee, by the way, is optional year to year. It affects your factor and how much you earn. You could just earn whatever the index does if you don't want to deal with the fee. But if you're going to maximize or turbocharge growth, this can be a great tool. And we have the steady Eddie consistent options too. For those that want to see more steady, consistent, every year type growth, right now, 5% crediting, ongoing with guarantees. Okay, for a lot of folks, that's a nice fit, or some of both. And that's my point is we can mix and match and use these tools, what's appropriate for you to maximize and accomplish your goals, maximize your returns with some safety, with a floor. And, there's tax benefits involved and all that too. But here's the thing. I'm going to do you one better. Like I said, with the tax things, like last week I talked about with the CARES Act changing a lot of the IRA rules. We can get out of all those rules and take back control of your money so you don't have to deal with all those rules. You can get out of that, okay? And because, like I said, if the rules don't fit your plan, then what? Well, we can get you out of that. It may take some time, but we can accomplish that. But let me do you one better. I mentioned briefly last week that there's a couple of ways to access funds from these accounts, and sometimes when there's a knock on them, and which is valid. I've run into that where you access funds from. Let's use the fixed option because that's pretty simple to understand. If you're getting credited 5 and it's costing you 7 when you take the money out, that can work temporarily, a low, inexpensive use of the dollars, but long term, that doesn't work so well. Okay. And I've talked a lot about the fixed tools having a crediting interest rate similar to the what you're getting charged. So the money is in essence a wash, or it's a low cost use of the dollars. And closer to the wash you can get is better, but you can also get positive arbitrage with the index tools. If especially using this performance factor, using my example, 4.65 is what they're currently charging on their loan, and if you got credited the 11.5, as I pointed out, you're making the difference. Okay, so even when you grow the money, you can grow it at tremendous upside option potential. But even if you borrow some funds, you can still get a nice positive arbitrage, particularly in positive years, okay? But even with the fixed option, I can show you how to get a positive arbitrage using a bank. See, there's banks out there that will do something called a collateral assignment. And I'm going to talk about this more next week. Hopefully have one of I'm going to have one of the bankers on as a guest to share this more information with us. So I'm kind of giving you a bit of a tease here for next week's show. And that is, they're currently charging rates. So work with several different banks, but one in particular charging 3.95, and they charge prime, which is below that right now, or 3.95 is their floor. But even on the fixed option, if you're getting charged 5% on your loan, you can choose to instead. I'm doing this myself. Why pay 5 when you can use a bank and use the collateral assignment? The policy is the collateral. There's no other fees or costs. It's a line of credit. So it's very simple. And, the interest is 3.95. For those of you out there with policies that have higher interest, a lot of folks recently have got policies with cash values and have taken loans and accessed funds from them for various needs, particularly recently. And a lot of contracts out there have interest rates of 6, 7, I've seen 8% even. And we can refi that, if you will. We can use a collateral assignment. Your credit doesn't need to be that great. You can't have any judgments or liens, those kinds of things. But outside of that, pretty much we can get you qualified. And no fees, line of credit. And, you want to pay 5, 6, 7, 8% interest or 3.95. And if you're getting credited 5 or 6% interest and you're paying 3.95, even in a fixed situation, there's a positive arbitrage. In other words, you're earning interest on monies that you've borrowed and spent. Because it's collateral. It's a collateral assignment. So the policy is the collateral. The cash there is the collateral, right? And you're getting, for example, getting credited 5 or 6%, depending on which contract you're dealing with. And with the bank is charging 3.95, for example. Pretty interesting. So my point is, by using the insurance industry, we'll get into it more. We're going to get into this in more depth next week. Like I said, I'm going to bring a guest on, one of the experts from one of the banks. We work with several different ones, and depending on your situation, I can steer you to which one is the best fit with the best rates. There's not many banks that offer this out in the country, but we've identified some of them that do. And by all means, if any of you know of a bank that uses life insurance contracts for collateral assignment, please notify us at yourpersonalbank.com. Be happy to check them out, because it's literally a handful that we've identified that do a good job and have great rates. But stay tuned next week, because we're going to go into more depth on this and how you can not only, as I've talked about earlier in the show, grow your money with a factor of up to 2.7 times what the index does, minus the fee. You can have a floor, so you can't lose more than the 7.5% in any given year, but you can get tremendous upside potential with tax benefits. Or you can do the steady Eddie consistent, get credited these days 5% consistently with tax benefits. And then if you want to access the funds, whether it's the performance or the guarantee, or the fixed steady Eddie, we can still get a positive arbitrage. So even when you're using the money for other purposes, whether it be emergencies, opportunities, whatever that may be, you can earn a positive arbitrage, earn interest on those dollars as you're using them elsewhere. And that's one of the key unique benefits of the personal bank tool. When you use dollars from other accounts, those monies aren't earning anymore. They're gone, right? You applied them elsewhere. Here you can still earn interest, and we can show you how. Contact us at yourpersonalbank.com, and stay tuned Tuesdays at noon on Money Radio.
Listen next week at noon for more information on Your Personal Bank. Contact Ference at 866-515-6280 or online at yourpersonalbank.com.
This show is designed to provide accurate and authoritative information. The presenter and guests on this program do not engage in rendering legal, accounting, or tax advice. Expert advice from a professional involving your specific situation should be sought, if required. Permanent life insurance is a long-term investment. Products, optional features, and riders may have limitations, restrictions, and additional charges and may not be available in all states. Withdrawals beyond principal may be taxable income. Excessive and unpaid loans may cause the policy to lapse. If a policy lapses, unpaid loans are treated as distributions for tax purposes. Replacements may not be suitable for everyone. There may be penalties and surrender charges when replacing coverage. New products may include new surrender charges and contestability period. Policy guarantees are based upon the claims-paying ability of issuing insurance company and do not apply to the investment performance or assets in the underlying variable portfolios. The life insurance and annuity products in this presentation are not FDIC insured, may lose value, and are not bank guaranteed.